Welcome everyone to the call. We'll let folks settle in for a few seconds here. It's good to see everyone this Friday morning. Senator Kudura, good to see you. Peterson, great to see you here. It's good to see state legislators joining us for this critical conversation. And I see partners across the board who are here. So with that, I will kick us off and hand over to the great capable hands of our member and partner in Flo, who's going to be facilitating a lot of our conversation today. But on behalf of the Housing Development Consortium, in partnership with the Washington Association of Community Action Partnership, we have convened this discussion to really talk about a challenge that is facing our market here. David just a few seconds ago called this the insurance being in a hard market. It's challenged, and we know that that does impact and exacerbate the affordability issue that we have locally. It also does threaten the sustainability of providing affordable housing for low-income households across our community. We have an outline of great speakers that have been pulled together to facilitate a discussion amongst all of us in the sector. And we'll be talking about the challenges globally, but beginning to think about what the solutions are. We do know locally here in Washington State that the state legislature does have a proviso that was passed through House Bill 2329 that established a work group at the state level to look at the insurance market for affordable housing projects that are housing trust funded and supported, and looking at what could be done by the state in the coming year. There's only so much that can be done within that scope of work, and the challenges are wider than that scope of work. So how do we begin to think about the opportunity that's in front of us in 2025? And then long-term, what are some other solutions that we can be tapping? So we're hoping for a conversation that is well-rounded, begins to anchor the important collaborative effort that this challenge calls for. And we couldn't be more luckier to have all of you here to begin to think together about what those next steps are. So with that, I will just give a quick overview of what our agenda will look like, and then hand over to Flo, who's going to be facilitating this session. Let me pull up the agenda here. So for the first minutes, we will get some grounding of the overview of our session objectives from Flo, speaking from both her perspective as a provider and as a partner and member here in the housing sector within HDC. And then we will get a presentation from a housing provider perspective from Lynn Bahai-Lehigh, just talking about the trends, what they've seen so far, what they believe is driving some of the cost factors. And then we'll move into a panel discussion. And within the panel discussion, we have pulled together perspective brought from the Office of Insurance Commissioner. So we do have David Fort here from the CAP agencies. So we will have some representation included on this panel, as well as from affordable housing provider, as well as insurance perspective for a discussion. And then we're aiming to have a breakout session. So we hope some of that time works for folks who are on this call, just to begin to get into the discussions on what are some ideas for solutions and how do we collaborate on those, what's underway, what are some promising practices, and where does that work exist currently, and how do we begin to thread the needle? And then we'll come back and just close with report backs on some of the small group discussions. With that, I will hand over to Flo Berman to take us over in facilitating and emceeing this discussion. Flo, over to you.
Thank you very much, Patience. I appreciate this invitation to come together with my colleagues and with our, supportive representatives through the Housing Development Consortium and also our legislative representatives. I see that Representative Peterson is on the call, as is Senator Patty Kuderer, and there may be others or their staff. So thank you very much, everybody, for coming together. I think we all know that as housing providers, we are in the same boat. I'm putting on just a couple of slides that I had put together for the Office of Insurance Commission for one of their meetings. My agency is one of those who are participating in it. They're doing a study that was passed by the legislature last year to look into the problem of affordability and even availability of insurance for affordable housing, specifically Housing Trust Fund, which is almost all of the buildings that my agency runs. And so through gathering information from different folks, and David will speak to that later, they're going to put together a study and present it to the legislature. And then the legislature is going to need to help us continue to stay in business. Because, you can see that my agency is a big agency. We have, together with Coordinated Care, which does the permanent supportive housing in King County, together, the Archdiocese and Housing Authority has 63 buildings of affordable housing, and it's all different kinds. So I hope I'm going to be able to switch slides here and not bore you with the same one. There we go. So these are the challenges that we're facing. And I know that you folks on the meeting here have the same thing, that the insurance market costs are forced on us. We have very few carriers left. Our agency has a hard time even finding coverage at all. Over the last 5 years, our insurance premium has tripled. And far worse is our deductible is now $500,000 per incident. So Catholic Housing Services is, together with the Archdiocese of the Catholic Church, in an insurance pool with the idea of trying to keep our costs down throughout. So it's not just housing, but it's all the other work of the Archdiocese. But even so, even though I know other agencies on this call have your own brokers, your own insurance, we're hearing the same thing from everybody. Costs for unit turns have gone way up. Vendors are charging us more to do the work. We have more damage to units. Aging buildings are costing more for upkeep than was planned 15 years ago, when the building was built and we did a nice pro forma. And so we end up with huge costs that our agency is not able to bear into the future. So this is a list I put together for the Office of the Insurance Commissioner, just about some of the incidents that we had had. This year we had pipes freeze and burst in 2 buildings, huge damage. Last year we had a number of incidents where sprinklers go off because of fires in units, but then you have the resulting flood of water everywhere, damaging many units. We've had some damage by residents in crisis. We have accidents like a pot left on the stove, and just one after the other, these incidents really come out of our pocket. So we can't do this going forward. We're doing the work for our community, but we're also doing work on behalf of the state of Washington. And so we need my agency, speaking for my agency, we need the state of Washington's help in solving this problem. And I think that's why we are all here together today. So I'm going to get back to the agenda. The first presentation is by the good folks from Lehigh. Lynn, you're going to talk about the impact of rising insurance costs and the impact on affordable housing providers. So we have 15 minutes set aside from that, and I will try to mind the clock. So thank you, Lynn.
Thank you, Flo. Thank you to Patience from the HDC. Thank you very much, David Forte, for putting this together. Rising insurance costs has been a terrible problem for Lehigh, and our insurance premiums have increased 137% since 2021. It's constantly increases. Worse than that, though, is that our deductible is now 100,000. Thank goodness, Flo, it's not at 500,000, but 100,000 is a terrible amount for us to have to absorb. And that is per occurrence. We're also being asked in housing, more people in permanent supportive housing, low barrier, and the damages from that are tremendous. Many of it intentional from mentally impacted tenants. We're taking, them straight through coordinated entry and finding that they may not be housing ready, and there isn't enough case management services in the world, and more importantly, professionally licensed services to help them. I don't know how we would withstand a $500,000 deductible. I don't know that we can continue with a $100,000 deductible. To put it where it's at, about 6 or 7 years ago, and for the time before that, we would have maybe one claim a year, and we had a $5,000 deductible. I was shocked when it went up to $10,000. Flo's nodding her head, yes. It's a terrible, terrible deductible. So then what does that mean for us in development? Most of our properties that we develop are done with assistance with equity through the low-income housing tax credits. Our syndicators, our investors are not willing at all to accept a $100,000 deductible. In fact, most of the limited partnership agreements that come through have a $25,000 deductible, which is just impossible. So many of them are requiring that we put up an insurance reserve of 75,000 to 100,000, which absolutely dollar for dollar impacts our developer fees. So having to put up this cost in advance, not knowing if we will ever need the reserve for every building we develop is costly. It's, just straight out of our pocket. Really, we need developer fees to operate. One of the issues we're having is crime in the buildings. There is a large criminal element, and we are not getting sufficient support from the police departments. They often will not come out. We have a tenant right now who has gone after some tenants with an axe and is threatening to bomb the building. We can't, right now, we have sent a letter to the chief of police, but that person is in our building today. I can tell you a horrendous story at one of our buildings where we had our manager went to knock on the tenant's door. This is a homeless building. The tenant opened the door. He's a known drug dealer, and she saw a body slumped. So she backed out and called the police. The police came, found the dead body. The unit was full of fentanyl, and arrested the tenant. The tenant was released a day or two later on a $1,000 bond. Now, which drug dealer doesn't have $1,000? That made no sense, and returned to our building. I emailed our attorney asking if we could evict, saying that the unit was not habitable. I had a report from I had an environmental assessment done saying that nobody should be living in the building, in the unit. And the attorney said, no, we could not evict. My thought is we could say, hey, you can't be there, just as if the unit had burned down. But no, he came back. You ever been screamed at in an email where it's all caps? He was screaming. Couldn't do it. We did get him out, offering him cash for keys. And that is expensive. So that is one problem we are having, is damage to units, damage to tenants, and not being able to evict. That eviction moratorium has really hurt us badly. But let me pivot back to the insurance conversation, although the two impact each other. We are doing what we can to mitigate damages. Flo, I see that you had a pot left on a stove and flooding from sprinklers. Our insurance company suggested and then required, and we have installed fire suppressor canisters above all our stoves. I had to sign to that. And what those do is they will release the fire suppressant if there is a stove fire at a lower temperature than the sprinklers will go off. So we don't have all that horrible flood damage and the water flowing down our elevator shaft. And at that point, we can look at hundreds of thousands of dollars of damage. So, we do utilize the suggestions that they make. Some of them we reject, like they wanted us to change out all our washer hoses, from the rubber hoses to the metal wrapped. See, you could just see Flo saying like, no. And that is what I said is, no, you can't show me that that provides a higher level of safety and reduced damage. And we have never had that kind of an incident. And they couldn't tell me that they have had it. So that is one they rejected. We have a blanket policy over our properties. We are similarly large as to Catholic Community Services. We're, like brother and sister. And so we have a blanket policy that covers all our properties, not each to their total property value, because the insurance company says, hey, Lynn, the odds of all your buildings being destroyed all at once is minimal, like non-existent. Our buildings are throughout Western Washington, although most of them in the city of Seattle. Becky, to answer your question, Brown & Brown is our insurance carrier, and I believe it was Philadelphia Insurance that was requiring it. I've been told, and I believe that one of the main causes of the rate increases is one, of course, property damage. That'll do it. Your claims history will do it every time. The other is that carriers are leaving the market. They don't want to be part of the affordable housing industry. I have in front of me a report. It's really great. By NDP Analytics, titled Increased Insurance Costs for Affordable Housing Providers. I will put that in a chat. It's dated October 2023. They're expected to come out with another report in October 2024. It really should be on the bestseller list. It's a very, very important document for our industry and for the purpose of reining in insurance costs. I was also provided a report that was done primarily in New York by the New York Housing Conference, titled "Alarming Risk of Rising Insurance Costs for Affordable Housing." Yes, I will try to post a link. Otherwise, if I can't find the link, because like I said, this was October 2023, and they haven't come out with October 2024 yet. It describes that the costs in the affordable housing industry exceed that of the market rate housing. And what I'm hearing and what I'm seeing, what I'm hearing that's disturbing me is that a keyword is being used a lot called, it has to do with the demographic. Well, let's translate that. The demographic is the income source of our tenants. I mean, that is absolutely what it is. And it's something which we need to address. I mean, should the insurance industry be allowed to charge more for insurance based on the demographic? So I don't know where our insurance is going to end up. Our insurance renews in April. When I first got hit with a huge premium increase in 2022, 2023, I thought it was just us. But no, obviously it is across the affordable housing portfolio. This is costing the state of Washington millions of dollars. Just literally, I can't even begin to estimate. Would also like to say that our rents have not kept up. Our rents are pretty much capped at what, 4.99%? It hasn't kept up with the cost. There's very little grant funding available from the state of Washington unless it is for permanent supportive housing. So our transitional housing, which we do have, and is for more difficult tenants, has no source right now for case management services, and that is where it is needed the most and where we have the most issues. We absolutely need to look to the insurance commissioner's office, working with the Seattle Office of Housing and the Office of Housing of the different municipalities and counties to help us rein in the insurance costs. They need to be reasonable and they need to be equivalent to what is seen in the conventional housing industry. So I don't know that I think I'm pretty much to time.
Yeah, you're just perfect, actually, Lynn.
That's rare, but thank you. And I really do appreciate everybody's attendance at this meeting. Thank you.
All right. Thank you so much, Lynn. That was a very illustrative presentation of the issue that's hitting your agency, and I think many of us. I don't know who would not be paying these high costs. So the next part is a panel discussion, but Patience's goal for this is to have pretty much all of it be an interactive question and answer session. So it's not just talking to folks, but it's back and forth and hearing from people what your questions are. We have some great panelists, and I will list the names, and then I will ask each of the panelists to please introduce themselves and talk about what your intersection with this issue is. Altogether, no more than 2 minutes each. And if you have a slide or two to put up, that's great, but don't feel like you need to. So the first person I would like to welcome as a panelist is from the Office of Insurance Commissioner, who's doing the work group study. And he's going to talk about the highlights of our challenges. And that's David. Is it Fort or Forte? I'm so sorry.
Oh, it's okay. It's Fort. Thank you.
Fort. Thank you, David Fort.
Yeah, yeah. And thanks to everybody for the invitation to be here. I am David Ford. I serve as the Senior Policy Advisor at the Office of the Insurance Commissioner. And this past session, the legislature has asked the Insurance Commissioner to study the insurance market for it. It was pretty specific. It's for housing providers receiving housing trust fund resources and serving extremely low income households. So that's the scope of our work, and we're to provide a report of the study by December 31st. What we've been working on to date is we've had some really informative work group meetings, and I'm going to encourage everyone to watch the July 9th meeting. This is when the insurance industry participated in the work group and provided their perspective, and I'll place a link into chat in just a little bit for that. Most of our current work now was around collecting data. We issued a couple different surveys to the housing providers that Commerce has identified for us. And then we also issued a claims-related data call to the insurance entities. This data has all now been collected, and it's being analyzed by an actuarial firm that the insurance commissioner retained. We also met with various housing providers in more of a one-on-one interview setting to learn about your business operations and really the nuances of housing, extremely low-income clients, and the things that Lynn was talking about. We've heard it over and over and over again. We also met with insurance producers to learn about the complexities of finding this coverage. And we also met with the risk pools that are really the main source of coverage for the majority of these types of housing providers. So for the next 6 to 8 weeks, we're going to be drafting the report and following up with any outstanding issues that we uncover during the drafting. And again, the final report will be provided to the legislature by the end of the year.
All right. Thank you so much, David. The next person, we heard that Scott Schubert is not able to be on the call. So the next person who's an agency provider is Amber Johnson from SNAP Agency. So Amber, can you please introduce yourself and spend a minute or two telling us how you are intersecting with this issue of insurance?
Absolutely. Excuse me. Good morning, everyone. My name is Amber. I am the Chief Operating Officer at Spokane Neighborhood Action Partners in Spokane, Washington. We are a multi-service community action agency, and we also own 15 affordable housing properties in and around Spokane County. The perspective I'm bringing today is one of a provider that is not a permanent supportive housing provider, but who is still completely struggling with the insurance increases. So I just want to mention that I think it's short-sighted to only look at the cost of insurance for those serving extremely low income and permanent supportive housing, because the impact is so much broader than that. I also have the unique position of I am a board member for the nonprofit insurance program. They are the insurance provider for SNAP, but I also kind of bring a little bit of that industry knowledge as well, and some of the balance that needs to take place there. I am not surprised that there are some providers that have 100K or 500K deductibles. It makes me feel very, very fortunate that our deductible was only $50,000. And we still struggled with how we were going to be able to file a claim with that. Our margins in affordable housing are incredibly thin, if we even have a positive margin most days. And any increase, our increase was about 40% this year for our insurance.
Wow.
And Let me tell you, when that came through, it was a very serious conversation about whether we could even stay in the business of affordable housing. Whether it's the way that our projects are funded and the performers that we're forced to use when we're applying, that envision a 3% increase in expenses, which, geez, wouldn't that be lovely these days? 3% sounds fabulous. And a 1% increase in revenue, which during the pandemic we know was non-existent. And trying to balance the needs of our tenants and not increasing. We don't want to be the landlords increasing rent $500 a month to try to cover these expenses. So that's how I intersect with this conversation, and I look forward to the conversation.
All right. Thank you very, very much. Then the next person is Amanda Santo from the Multi-Service Center, who is also an affordable housing provider.
Yes, good morning, everyone. Amber, I just want to lift up everything you said. I could really relate. So thank you. Amanda Santo, she, her pronouns. I am the Chief Operations Officer with Multi-Service Center. We are headquartered in South King County, but also have affordable housing in King and Pierce. So we have 15 properties, over 1,000 units. And to Amber's point, only 2 of those are permanent supportive housing. So this is also impacting general straight affordable housing as well. I'll also be remiss. Thank you, patients, for putting this together and all the electeds on the call. I'm also an HDC, proud HDC board member, so really happy to see HDC and as a CAP agency have WASCP in the space as well. So intersecting in that space as well, and just an affordable housing advocate overall. So appreciate all of us coming together around this really concerning industry and how it's impacting affordable housing. Flo, I heard you say earlier your premiums increasing around 3-fold. We are also seeing that the last 5 years, our premiums have tripled. And again,
Wow.
this is not, we are not a predominantly permanent supportive housing provider. We are a straight up affordable housing provider up to, some of our units go up to 80%, majority go under 60. We last year were threatened to be dropped by our primary insurance provider because we were an affordable housing provider, right? That was the main, they said, you are risky because you provide affordable housing. So the tax, the affordable housing tax, which I think Lynn kind of alluded to, right, is happening, right? There is an element and a stigma around affordable housing that is also relating to and justifying these rate increases on affordable housing providers. We are really fortunate to also have a much lower deductible, but even with that, we are operating at very small margins. And we're also operating a lot of affordable housing that are smaller projects, 20 units here, 8 units here, 24 units here, really small, some of these are small projects with really tight margins. And so the reserves are tight. We do our best to save in years we can, but rents have not caught up with expenses. So we are struggling. I recognize the insurance market on a national level is being impacted by climate change and lots of claims happening. And so we're seeing rate increases across the board in homeowners insurance and multifamily housing. I think creating, having the burden of fixing that or responding to that be on the affordable housing providers, trying to, as we all know, the market is not designed to support low and moderate income housing. And so there is subsidies that we need our public partners to be at the table having these conversations about how we ensure that affordable housing does not collapse on our watch, right? So we need to work together to find solutions, and we are raising the red flag. So thank you for all being in the space together.
Thank you very much, Amanda. And the last person on the panel is Peter Tran from Lockton to give us an insurer's perspective. And full disclosure, Lockton is Catholic Housing Services insurer. So Peter, welcome to the panel.
Thanks, Flo. Good morning, everybody. I'll make a quick clarification, right? I mean, we're the brokerage firm. We help affordable housing developers, owners, and managers kind of navigate tough market, right? And so I'll do my best to put my underwriter hat on to give perspective as to why maybe insurance is difficult. But for the most part, I've spent the last decade or two really advocating for affordable housing and educating the insurance market on what risk you all may have, right? And so I think we've made some headway over the years, right? I think it's been mentioned a couple of times, right? The false perception of high risk because of tenant base and whatnot. We've spent the last decade or two trying to really educate the markets, right? Of, the regulatory guidelines and the things and the inspections and the compliance that is associated to affordable housing oftentimes can justify that they're better risk, right, than market rate. And so that's what we spent the last decade or two trying to advocate and educate, so that there isn't them penalizing affordable housing or operators for high risk.
All right. Thank you very much, Peter. I would like to then open the floor to questions, and hopefully our panelists may have some answers or at least affirm the questions. And we have 50, that's 50 minutes for that, or maybe 40. I'm going to say 40. So let's, if people have questions, I'm not sure the best way to do this. Patients, do you want folks to put questions in the chat, or should they just raise their hand or jump in, or what? I do see one hand up actually, so I'm just going to go with the hand up, and that is from Representative Strom Peterson.
I'm getting there. There we are. Thanks, everybody, and thanks for the presentation. Certainly something that we've heard about in this space, as well as just everybody's home insurance. But I'm curious, the last statement that it seems like you're getting information from insurance companies specifically that say because you are offering affordable housing, therefore your rates are going to be higher. Has anybody, and I'm just sending a message to the AG's office, has anybody looked into violations of Fair Housing Act? Because they're differentiating populations just based on income?
Thanks for that question, Representative Peterson. I think what they would say is that they are not differentiating, that we in our history and our claim history are just riskier in general, and that the market is communicating that to them, and therefore we are going to be hit with higher costs. So we are also, I think, folks on the call have mentioned, because we're operating on such small margins, that those rate increases have a much larger disproportional impact, or the larger operational impact as affordable housing providers. I think they would say they aren't discriminating or violating fair housing, that they're just responding to riskier claim history in the affordable housing market.
Okay, so I see more hands up. Linda Garcia has her hand up, and then after that, Senator Patty Kuderber.
Thanks, Flo. I do want to take a few moments to check in with a response to Rep. Peterson, but I'd like to go ahead and defer to Senator Kuderber first.
Thank you, Amanda. I appreciate that very much. My question is a follow-up to Senator Peterson, Representative Peterson's question, and it's actually for David. And having worked in, employment discrimination, people can say they're not discriminating all they want, but the facts may show that they actually are. And I'm wondering if the data that you're collecting, David, will allow us to make that determination one way or another, because I do think that this is something the AG's office should be informed of.
Sure. Thanks for the questions. It's going to be interesting. Data collection was a little difficult. The different types of insurance markets that come into play with providing coverage to housing providers is kind of unique. So I just want to address the different types of insurance markets that are at play here, and then I can answer the other question as well. So there's really 5 different insurance markets and all of their pressures that they're having that intersect with this specific line of business. We have what's called authorized companies. These are companies that the insurance commissioner heavily regulates. We review policy forms, we review rates to make sure that they're adequate, they're not excessive, they're not unfairly discriminatory. That market's not really participating in this risk. And then we have the next layer down is what we call excess and surplus lines companies. These companies take up about 14% of Washington's insurance market, and we consider them kind of a safety net because they're going to take on the risks that the normal market won't take. This market, though, is less regulated. We do not review rates. We do not review policy forms. To access this market, you have to use licensed brokers like Peter, who are regulated, and going through Peter, you're able to then tap into this safety net environment. Then there is another entity called a risk retention group. And risk retention groups were formed by the federal government in a similar hard market time in the mid 80s. And we have no regulation of risk retention groups. They just file a notice when they're doing business in Washington. We can't reject a notice. They just inform us that they're operating here. We do not review or approve policy forms or rates. And then there's another layer. They're called risk pools. And this is really where the majority of the housing authorities and the nonprofits are able to find coverages. And this is authorized in 4862, and it allows local governments and nonprofits to self-insure. And the self-insure mechanism is forming a risk pool of like entities. And again, this isn't anything that the insurance commissioner regulates. This is regulated by the state's Office of Risk Management. And there are some financial reporting requirements and things that they overwatch. And there's probably about 16 risk pools in total, but there are really 3 that affect your line of business. The 5th market is called the reinsurance market, and this sits above all of these insurance entities, and they provide reinsurance agreements. They're basically insurance companies for insurance companies, where they will provide a catastrophic level of coverage, which allows the primary insurers under them to be able to accept more coverage and to maybe charge less amount. When we talk about a hard market, this is happening right now against all lines of business. It affects the most vulnerable lines of business the most. Besides yours, we're seeing it occur in adult family homes, skilled nursing facilities, foster care, even some of your condo development places that the industry has deemed risky or litigious. There's a lot of pressure there. To answer the question now, going back about is our data going to be able to uncover unfair discrimination? And let me say unfair discrimination because that's what insurance does. It discriminates, and it discriminates through risk classification. What makes unfair discrimination in insurance is when 2 like risks are treated differently. So if one risk has the same risk profile as another entity, they need to be priced the same. Of course, as in the Office of the Insurance Commissioner, we're able to enforce those statutes on the entities that we directly regulate. Again, your space has been abandoned by the admitted market. They find it too risky. And so these other entities are trying to fill the gap. And I hope that answered the question.
All right. Thank you. Linda, your hand is still up. Do you wish to speak?
I wanted to really quickly respond back to Senator Cooter and Rep. Peterson. We have the data. We did a very lengthy survey of all of our 30 community action agencies across the state, and most of them are affordable housing providers. And so I'm happy to share that data with you and have a further discussion offline about it. I will also say that in that survey, and then follow-up post one-on-one interviews with the providers who do provide affordable housing, we heard a lot of they're not stories. I don't want to call them that. We received a lot of information saying that they were being told that one of the primary reasons from the insurance companies for significant increase in their premiums was due to them providing housing to people who had behavioral health issues or concerns. That's not okay with us. That feels very discriminatory. I believe Nicole Macri was in one of the last meetings and dropped a link into the chat regarding that specific issue where several other providers said that they were hearing the same thing. And unfortunately, I didn't grab that, but it was something that had been legislated about that discriminatory practice. So we want to make sure that that doesn't continue to happen and that our providers aren't dinged for that. We're seeing upwards of 300% increases in those premiums and dealing with the same issue of where's that decision? Do we need to close down? Can they continue? So anyway, sorry to take up all that space. I just wanted to make sure that that y'all knew that we do have the data. Happy to share it with you. And I see a lot of our community action agency providers on the call today. I'd highly encourage you to speak up and ask questions while we're here today. Thanks.
Okay, thank you. Next hand up is from Lynn, and then after that, Rena. Lynn, you're muted.
There we go. So one of the things that I'm seeing in the New York report is that there is redlining of certain areas of cities. And I believe that is happening with some of our properties. We're having a harder time getting insurance on properties in the Central District. We're looking at purchasing a market rate building right now that has over 300 units. The P&L that we received from the owner showed insurance costs of $115,000. Our insurance broker did a preliminary quote of $200,000. And we would be turning it into 60% affordable housing, through attrition and releasing. That's a problem. Another is that one of the reasons our premiums have gone up is the shrinking insurance market. Many carriers have left the industry, and I don't think it's right that an insurer in Washington be allowed to insure market rate buildings, conventional properties, and not affordable. They need to be taking on all of our housing needs if they are going to be operating in our state.
All right, thank you. We have Rena next, and then Lucy.
Hi, I'm Rena Shaver. I'm with Okanagan County Community Action. We're a small agency, and we have been operating here for 60 years. We do most of the emergency assistance programs for the county for food, shelter, eviction prevention, rental assistance, home weatherization. And recently, I mean, our county has declared an emergency for a housing crisis, just like every place else. Here we have almost 400 people on the PIT count, 600 additional on a waiting list for the Housing Authority properties, which is subsidized housing. So our board wants us to move into permanent supportive housing, and this scares the heck out of me because we don't have a cash flow. We operate on 100% designated funds from county, state, and government sources. And our pro forma for a LIHTC project, a 72-unit permanent supportive housing project, which we are going in with together in partnership with the Colville Indian Housing Authority. The pro forma on that, the margins are already very thin. And I don't think that our developer is taking into account all of the information we're hearing today. And it makes me wonder, do we even go into this line of work to support our clients? This is pretty scary conversation.
All right. Thank you very much, Rena. Lucy.
Hi, I'm Lucy Michowick with Coastal Community Action Program. We're here in Grays Harbor County on the West Coast.
Okay.
We, besides Linda, you mentioned the housing with folks with mental health issues. We have 5 homes related to that type of population, and we have seen and heard of the increases related to that higher risk population. And not only do we have housing, but we also have other services like in-home care, chore services. We have senior centers, and the increase is related to some of those semi-professional liability programs that we have. And as community action agencies, I mean, we take on those type of things where no other industry or no other groups will take, because we can usually work those very efficiently. But with these high costs, I mean, we had a 300% increase over the last 5 years, or last 3 to 5 years, and it is a struggle trying to make things pencil out. So we hear you. We'd love to be a part of this group. Hopefully we can find something that can help us all out, and that the industry understands that community action agencies, nonprofits take the hardest to serve programs and groups, because we know how to do it as others won't even try to attempt. So that's just my 2 cents. Thank you.
All right, thank you. I don't see any other hands up. We do have until 12:10 for this panel. So if other people have questions, want to ask anything specific of our panelists or of our colleagues here who are all on the call, now's a good time. Rena, your hand is back up. Would you like to speak again?
Sure. I just want to mention that we don't operate housing yet, but just our general liability insurance for our agency, which is, again, a very small agency, went up 18% this year. That represents around over $20,000 for us. And again, we're operating without a cash flow or generation of revenue under these designated grants. So insurance in general for housing or our agencies is out of control.
Can I mention something real quick?
Do.
You know, the increase in insurance is obviously incredibly difficult for all of us, but I think I would be remiss if I didn't mention some of the impacting issues around that. And this may be unpopular, but I'm going to say it anyways. You know, I think we struggle in affordable housing with how difficult landlord-tenant law has gotten over the last couple of years. We are all very much in the business of keeping people housed, of putting forward reasonable and affordable rent increases, and doing our best to really have safe, decent, affordable housing. But the story that was shared earlier about the drug dealer and some of the challenges with law enforcement, that is not a unique one-off story. I have had a building fire that was directly impacted by a lack of law enforcement response. And I have also had large claims directly related to the inability to be able to evict a tenant who is causing significant damage and significant harm to others in the property. And again, it is a very fine line we walk in the affordable housing world. Our first response is never to provide a 10-day notice and to move towards eviction. But when we are in a position where we are, for lack of a better term, stuck with tenants who we know are going to cost us thousands of dollars in damage and we can do nothing about it, the message back from the attorney on, nope, you can't evict, again, that's not a one-off response. That's a very common response from our landlord attorney as well. You don't have enough. Yep, they were arrested. Yep, they punched the guy in the face. Not going to go through court. Sorry, you're stuck with this person for a while. That obviously impacts our insurance rates as well, right? It's another claim that we have to file, whether it's a general liability claim or a property damage claim. And that just adds to the magnitude of the problem that we're facing.
Thank you for jumping in with that information. I see Senator Cooter's hand up.
Yeah, thank you. And thank you for sharing that, Amber. I certainly have heard these stories before. I want to make it clear that the changes that were made to the RLTA only related to non-payment of rent. They did not apply to the 3-day ability to evict for damage to the property or criminal behavior. And I have said this before to landlords that have written to me, and I'm surprised that your attorney is telling you that you cannot evict. When I dig into this more deeply, I hear exactly what you said about law enforcement. This is a separate issue, as was the court issuing a $1,000 bond on a drug dealer case and allowing someone who is clearly a threat to public safety out on the streets. And I've had conversations with the Superior Court judges about this and the fact that they were not prioritizing public safety eviction cases, and they were getting stuck with this general backlog. And we have a backlog in the courts of all cases, not just evictions. And when I was speaking to providers, and I would tell them that the courts already have the ability to prioritize public safety evictions, and they have now since done that. They don't need a law; they don't need the legislature to act on that particular to pass a law requiring them to do that. They have the ability to do that, so they are doing that now. I think there is a lot of, I think we need to have some general, I guess, educational information about the process of what's changed and what hasn't changed, and how we can help you with the public safety risks that you're facing, because that's not acceptable. And it does need to be addressed. And with law enforcement not responding, and I don't know if this is in the King County, Seattle area, but that is one particular law enforcement agency, SPD, that I've been hearing a lot about. So I think we need to look into this much more closely and find out what it is that we need to change, because the changes that were actually made to the RLTA simply gave people a little additional time to pay the rent. So from 3 to 14 days, it stopped the automatic shifting of attorney's fees from the landlord to the tenant. And it also allowed for the judge to use judicial discretion. So if you were laid off from your job and it took 7 to 10 days to file for unemployment, you could get that time through the judge. So that's real. And then we, of course, allowed for the right to counsel for indigent tenants. Those are the major changes. And I would love to hear more about the challenges that you're facing. So I also invite your attorney to contact me directly, as I was the prime sponsor of those bills. And I'm more than happy to speak with your attorney directly about this, as well as with staff. But I think we should put our heads together and figure out what it is we need to do in order to make sure that you're not in a situation where you have a public safety threat that's not being addressed.
We have a few more minutes. I will say that during the course of this call, I got notice that in one of our buildings, a tenant chased the manager down the hallway with a knife and has since been arrested and is being brought now for a psych evaluation. And this is the real work that we're doing and the real challenges that we face. Half of the state is still under the COVID interpretation in the courts that a 3-day waste and nuisance notice is actually 30 days. So that's a real public safety problem for us. Dustin, your hand is up, and then we just have only 4 more minutes.
Hi, good afternoon. So I run a accountability-based family shelter in Skagit County, as well as affordable housing and transitional housing. And I have 2 quick questions. One, is there any chance that we can get a copy of this presentation? Because I think I have a city council member that was able to join us, but no one from our county is on this call. And 2, I think we need to also underscore the fact that the State Department of Commerce is really shoehorning a lot of us into low barrier programs and low barrier policies. And one of the instruments for that, at least in Skagit County, is coming through the utilization of our vulnerability assessments. And so that's increasing our risk, especially to children that have high ACEs. And what our county is telling us is that the reason that they're shoehorning us into this direction is because the state has a vested interest in assuring that we are addressing people that are dying on the streets, and with less concern for people that are dying in domestic violence situations, dying because of falling vulnerable to a predatory family member or someone else, and that's really being driven by state commerce. So I hope part of this message is getting to those folks.
Thank you. 3 minutes left. Dorsal plans.
Thank you. And kind of follow up to that comment, I was kind of curious to just directly ask the panelists, the providers here, have any of you received kind of that feedback from your insurance providers that some of these challenges are actually associated with policies like Housing First or harm reductive models, or is it consistent across the industry, whether you're harm reductive, Housing First, or an accountability model, that the insurance just is going up? Thanks.
Yeah, I can answer a little bit to that, Dorsal. You know, the vast majority of our units at multi-service center are not permanent supportive housing, and not serving the full wraparound supports that come with permanent supportive housing. And so in some of our units, you know, we consider 50-60% workforce housing. Even those projects are seeing astronomical increases. This is not just a behavioral health dynamic and issue, although that is a factor and a layer to this conversation, clearly. But it's beyond that. We're also seeing, I think Amber also expressed, and with SNAP also experiencing huge increases in units that are not permanent supportive housing. So I think it's both. The behavioral health component is a challenge operationally. I know, and with HDC providers in Seattle, King County, but also statewide, we're seeing the need for more behavioral health services across the state of Washington in these housing projects to support our residents in need that are in mental health crisis. So additional operations is going to be needed to support those areas. You know, we know that behavioral health is underfunded and as compared to the need and demand. So
That's right.
but I think that the insurance issue is beyond just PSH and housing first models.
All right, I think that is a great comment to transition to the next part on our agenda, and that is breakout groups. So patients or HDC folks, do you have instructions on how we're going to do this?
We do. There was one question that did not get elevated in the chat that I think could be worthy just elevating for the panelists before folks dive into solutions. And it's a question of if the state could self-insure. Could we get a state level self-insurance program or risk pool that could become this viable solution for low income housing providers? And could this be part of the work that's being done in the scope of the study as part of the recommendation? So we'll throw that out there before folks are diving into a breakout session for discussion to hear from the panelists.
Patients, I can add that there are risk pools already developed for local government housing authorities and then for nonprofit. So they do have, they operate very similar to a insurance entity in the sense that they have underwriting considerations. So they have risks that they're willing to accept and some that they don't. So an important thing is when you hear the word self-insurance, it means no insurance. And so this is really, I think the question is more along, can you create a risk pool with cross ownerships? Because, and I'm learning about your line of business as we go through the study, but you have different ownership structures of all these entities that provide it. So that would be something that would need to be considered when forming the risk pool. Risk pools work best when you have similar risks associated in the pool, and knowing that you have large developed housing providers, smaller providers, that might be a complicating factor. And then the sharing of the risk. I will say in our study, what's becoming apparent to us for the specific group that we're looking at, property loss is the main driver of cost. The liability side doesn't appear to really have been a problem for the last 5 years for the data that we can see, but many property claims have kind of driven up the exposure. So if you want to think about solutions there, you have to think, do you want to take what challenge do you want to take on? Do you want to take on the high frequency number of claims? Do you want to take on the catastrophic level claims, the multi-million-dollar losses? It may be helpful for the legislature to try to figure out, well, how can we affect one of those two? Because taking on the whole thing, that would require the state funding your property damage or your recovery, right? Insurance isn't meant to be used. Well, it's meant to be used very rarely. It operates best when many people pay into a pot and very few people have any damage claims.
Right.
So as we see the cost of things, everything's more expensive to do now. So the cost of repairs are gone up. And the long-term solution for property loss is mitigation. Find ways not to have the claims. And if you do have the claims, it's not a water damage claims that goes down 3 stories and affects all sorts of stuff. It's try to mitigate that. But that's not a short-term solution for the folks that are in the middle of this operational budget crisis that they're in. So I'll just
Right.
leave that for the group.
All right, thank you. Peter, your hand is up.
Yeah, I just wanted to take a minute or two just to well said, David, right? I think at the end of the day, your attritional losses, it's pretty clear by them being the insurance companies wanting a higher deductible. They're trying to get away from the attritional type of losses, right? So the kitchen fires and the water damage claims, that's why you're seeing them push big deductibles. And so they very much want to be there for the catastrophic type of claims. And so if that is the spectrum in which you all are being forced to go to, it'll be critical to have a better understanding of where your losses are coming from and having a good risk management and mitigation plan. That's where we're really trying to utilize data and analytics to identify trends and help owners and developers and operators identify where the risk is, so that if you are self-insuring with those attritional losses, you can better manage that risk and your overall costs of risk, right? So it used to be a fixed cost, now it's a variable cost that gets shipped back to you in the form of a deductible. It's going to be very important for you all to kind of understand where those losses are coming from, so that you can manage that total cost of risk, whether it's fixed or variable. And David, I would take just a quick minute to update everyone on marketplace. I would say that the property market, which historically has been where you paid most of your costs, right? I would say 75% of your cost has been property driven. That market seems to be improving. Okay, so from a capacity standpoint, it seems to be improving. And Becky, to your point, mainly for the larger groups where they have scale and size, where the multiple layers of carriers that are involved, we are seeing improvement and stability on that side of it. On the liability side, I would say it's the opposite. Okay, that casualty market is continuing to get harder. And that is due to a number of nuclear verdicts and bigger payouts, right? Claims. And so what used to cost $1,000 to fix a fender bender is now $5,000. What used to be a $5,000 med pay check to handle a slip and fall claim is now $1 million ankle, right? And so we are starting to see the casualty market, the liability market, move in the other direction. Of property, which is concerning, right? And for housing operators, the two biggest things that we're seeing is assault and battery, exclusions or sublimits, and habitability type of claims where there's class action suits amongst many different unit owners banding together to make a claim. And so those are things that we are seeing as a concern. Crimes, I think that there was mentioned earlier about, hey, we want to take over this property, or we're building this new property in this area. What the underwriters and insurance companies are doing now are running crime scores. And so with risk meters and crime scores, with an elevated crime score, you're going to likely see restrictions in coverage and or declinations from them wanting to insure it. So just something to be aware of. And, obviously security comes into play and risk mitigation comes into play. How are you going to combat those type of things if you are going to own and operate a property in a high crime score area? Those are the things that are challenging to navigate in the insurance market.
All right, thank you, Peter. Rena, I'll take your comment and that's it. We're a bit over into the next part of our agenda.
I'll be quick. I think Peter underscores exactly why we need state intervention on this issue. This is a population we're being asked to serve. So they are the highest risk population. Somebody has to serve them. We've stepped up. This is Dustin's point, and the state needs to intervene here.
I could not agree more. Thank you, Rena. So the next part on our agenda is breakout groups, and we might cut the time a little bit for that. Well, we had 15 minutes. We'll do that. I'm going to shrink the group reports. So 15 minutes to talk together. Each group, please pick somebody to report back. So Okay, we have been brought back together. That was the end of our breakout group. So I hope that was a good discussion for everybody. I know mine was good. And if people can report back, first of all, I don't know how many groups there were. Joanne, can you tell us that?
3 different groups.
3 different groups. Okay. So I'm just going to mix it up a little bit. And I should say that we have until 12:50. So that's a little bit of time. It's almost 20 minutes for our reports. And would somebody from group 2 like to summarize your discussion and, you know, bring forth any big ideas or big questions that you may have surfaced?
I think I was in group 2. We talked a little bit about what the future report may be able to provide. And we were ending a discussion a little bit about, and this is really interesting to me, about how some of the newer developments are having increased in insurance claims versus some of the older buildings. Because in my mind, if we're instituting the best risk mitigation products available in the newer buildings, they should be less likely to have a claim. And I'm going to ask Peter to add on where he was just finishing his discussion. Peter, is the cost more because the cost of repairing the newer buildings is more than the older buildings, or why are we have it seems upside down cost to me?
Yeah, I would concur, right? In the past, it's been newer buildings are better risk, right? And I think the specific cases in which were brought up in the breakout group were newer assets, primarily built, you know, as a frame construction. A lot of what we're seeing in the Pacific Northwest is a 5/2 type of construction, right? So a lot of frame in one building. The challenge there is driven a little bit about from the reinsurance, right? So as you kind of mentioned earlier, there's reinsurance is insurance for insurance companies, and the higher layers, because they tend to be larger assets. If it's $50 million in one frame building, the primary insurance companies will have to buy reinsurance, and that cost is becoming larger and larger due to all the things that are happening in the marketplace. As far as a risk is, there's been a number of claims in the last couple of years in that particular market, builder's risk, where there is a $50 million building that is, you know, at a very late stage of that completion that gets totally burned down because sprinklers and things aren't in place yet. And whether it's arson or a roofer that's doing hot work, it torches down the entire building. Those are catastrophic type of losses. And so that has impacted the market for those types of buildings in a great way. It also extends into the, you know, after construction, right? Those assets continue to be tough to insure as well because of what you mentioned a little bit in our session. You know, insurance companies typically like a good spread of risk. And when you have a garden style multiple building type of facility, you have that spread of risk. Whereas in a one building mid-rise, there's a lot of risk in that one building and a potential loss, maximum loss exposure.
Okay. Is there anybody else from group 2 who wants to reflect back to the larger group?
Just wanted to talk about the cost of claims in newer buildings just real briefly, which is the source of those, the cost has been actually the sprinklers. That's the water damage. We've had some very large 6-figure claims off of that.
That's right.
And if I could follow up, Becky, we've had some housing providers that want to put the locks on the standpipes. And some of the local, you know, fire marshals are like, you can't do that, right? Because they don't have enough wrenches in their trucks or enough keys to do all the unlocking that they would need. I think there is a pathway because when you have a sprinkler system go off when it's not putting out a fire, even when it puts out fire, it just dumps a tremendous amount of water that does a tremendous amount of damage down the building through layer and layer and layer, and you have all the displacement of the people. It's a horrible loss. But I think we need to figure out better ways to secure those sprinkler systems so the fire marshals are still okay with the life safety aspect of why we have sprinkler systems, and then be able to also have conversations about property mitigation. Like, are there ways to develop a better sprinkler system that can identify when there's not a fire and when it's being physically abused to the point of breaking? I'm not sure, but I know that that's a crossroads where there's a lot of property damage. And then frozen pipes, that would be the other big one. Yeah.
Okay, thank you.
Flo, real quick on that front, I would say, you know, from you folks that are looking at new buildings and construction and design of new buildings, I think that, Flo, you mentioned it earlier, right? Frozen pipes, a lot of those new buildings, you know, the sprinkler systems are in the attic space and are not insulated or protected against freezing pipes, simply because in the Pacific Northwest that hasn't been a concern. But I mean, in the Midwest, that is something that is taken into consideration as buildings are being designed. And so, you know, frozen pipes is a big cause of you know, water damage. And then so some of the risk mitigation efforts can be leak detection type of devices that can trigger an alarm of sort if there's a loss in pressure in those systems.
Thank you. Can we hear from group one?
I can go ahead and do that. I've
Thank
got
you,
my
Linda.
notes, so I'm not going to be looking at the screen.
All right.
Before I get to the solutions that were brought up, I wanted to talk about wanted to share some of the things that were talked about, particularly in serving the more challenging clients, without the support that's needed for the affordable housing providers to serve the more vulnerable and the more challenging clients that they have. It's a higher deterrent for providers to enter the market and continue to stay in the affordable housing market realm as well. Somebody brought up that they're not sure why the premiums have seen such significant increases of late, based upon behavioral health and mental health challenges, he wondered what's changed, or they wondered what has changed so far, because we've always had these concerns and challenges with specific clients, and he's wondering what leveled that part up. Also talked about corporate greed, political, environmental discrimination, parts and pieces of that as well. And Lucy brought up that with mental health clients, it's more difficult to find safe homes due to the rapid rise in the premium increases. And most people cited that the causation of that was behavioral health, and it is being pointed out over and over and over. It's not necessarily damage. It doesn't even get to that point sometimes. Many times it's just they're being denied or presented with such an significant increase based on the clientele in their affordable housing units. Some of the solutions that were talked about were a landlord mitigation fund, perhaps something similar to the fund to the existing landlord mitigation fund now, only for created for affordable housing providers. So kind of a different scope to look at that. And a big one that I've heard over the last several weeks is they'd love to see better access to O&M funds for non-PSH providers, because it's there for them, but it's not there for the non-PSH providers, which are equally critical in providing housing and sustaining housing for all clients in any type of affordable housing. And I think I think that's it, unless somebody else from group wants to add anything that I may have missed.
Okay, thank you very much. How about group 3?
That is me. I'm Danielle Garby Reeser. I use she, her pronouns. I'm the CEO of Blue Mountain Action Council in Walla Walla. We picked up on the legal challenges from the earlier conversation as well, and really talking about ways it would be helpful to have more education in our communities. We can have in our area a major safety issue. It can take 3 months and $10,000 of legal fees. We had a really bad case just earlier this week, and we get to crisis point, we're not able to be in prevention because it takes so long on the legal side. So that's one piece. We also raised up that Oregon has a rent incentive program that is called Rent Well. And if tenants have completed that curriculum, if they still do damage to an apartment, it creates a way for landlords to still get some funds, and that maybe is somewhat like our landlord mitigation fund, but some curiosity around what they're doing, and is something like that possible? I think similarly, we're curious is there a way to create an incentive fund that could actually pay tenants to allow more inspections and again, try to act preventatively around making sure units don't get into dangerous situations. And then we ran out of time. There's lots more good things. So if anybody else from my group had other ideas they wanted to lift up, I invite them to.
I think we talked a little bit about the landlord mitigation fund. That's well and good being here, but could the state risk pool that we discussed a little earlier be augmented with a mitigation fund, so folks are able to have access to resources as incidents are coming up? And we currently do have underway the agent repair fund that Representative Alvarado worked on this last budget cycle. Coming out of the capital budget, there's $5 million that's available for housing providers to access. It's for non-recurring incidents that folks can apply for. It's up to $200,000 that providers have access to. We actually have an event on October 1st with Representative Alvarado as well as Commerce to talk about the rollout of the dollars. It's a apply and get the resources as you submit your application, and we're encouraging everybody to take up those resources so we get to 2025 and be able to build on that.
Okay. Any other comments before we go to the closing remarks that Linda is going to provide for us?
I think there's a question for data on how do we anticipate the findings of the study shaping future legislation? I mean, there's been some great ideas coming out of this work. There's a question of data. It seems like there is data in the ecosystem that we could organize, and we're happy to collaborate. But could you speak to what you expect or anticipate as informing recommendation to the state legislature? And then a question to the providers on the call on what's the most critical outcome that folks would expect. So David, if we can start with.
Yeah, thank you, Patience. So the goal of the study is to provide the legislature with options of how they can affect the insurance market. It's not going to have the silver bullet that perfectly solves it. It's not going to have that. Our goal is to provide options and then provide pros and cons for each of those pathways. And so it's really being drafted as we speak. So for the next 4, 5, 6 weeks, we're really diving into the data that we have. seeing where the pressure points are and seeing if there's any policy ideas that could help relieve some of those. But for my initial review of things, you know, there's a short-term economic pressure on you that is probably not going to be able to be addressed by changing the insurance marketplace. You have an economic pressure that's slightly different, caused by the insurance market cost going up. But fixing the insurance market is a longer term if the private insurance market is going to still participate in this space. So that's kind of what the goal is to provide a bunch of options. I know one of the options is going to be how can state funding participate in relieving the pressure.
Yeah,
It has to be in there. So.
it has to be. That's right. So thank you very much. We have the rest of our time for closing remarks, which Linda has prepared.
Thanks, Flo. I thought I saw somebody's hand up just before this, but I didn't catch who it was. Did somebody else want to say? Julie, it was your hand up.
Oh, good.
Yeah,
Thank
I
you.
asked in the chat instead.
Okay.
But the question is it possible to request that, like for Washington providers, that risk assessment be based on claims history versus regional crime data?
Well, we don't have, I mean, the OIC doesn't have that type of authority, but the legislature can do many, many things. So, yeah.
Thank you, Julie, for asking that question. That's definitely something that we at WASCP will be bringing up with the legislators as we meet with them. This is one of our top priorities, and that's a big concern for us. So we want to make sure that we're very clear about that moving forward in our advocacy. So I just wanted to reiterate that the things that we heard today, the OIC study that David talked about, the report is due by the end of December, and they're going to be putting together all of the things that all of the remarks and conversations that they've pulled from their work study groups, from insurance industry and nonprofit providers. So we look forward to hearing that and to seeing how that's going to move forward in this next legislative session, how they want to tackle that. We definitely got to hear from some of the providers' perspective today, and I hope everybody here took that into account and is kind of ruminating on the things that they heard. And if anybody would like to be connected with any of our 30 agency representatives from across the state, I should mention too that Washington State Community Action Partnership has 30 agencies that serve all 39 counties across the state. Many of them have affordable housing. I believe the last count of affordable housing units, whether PSH or anything else, was just a little bit over 1,500. So we've got a lot. We've got a lot out there. So there's a lot at risk and a lot of impact, loss impact that can potentially be felt by these premium increase impacts. So we heard from some people. We heard from Peter, who is in the insurance industry, with some of the concerns about what they're seeing. And one of the biggest concerns that I heard and picked up was the problematic evictions. And that can be based on anything really, and a lot less knowledge about the newer post-COVID protocols that are now in place. And then Senator Cooter suggested that we do need more education on law enforcement agency eviction response. So that's also something that we'll be addressing. I would just like to say, from my perspective here, a lot of what I heard today seemed a little bit repetitive. On the insurance industry side, we do get it. We do completely understand that this is a hard market. We're not denying that at all. What our providers are trying to have heard from their perspective is that we need practical, immediate solutions to the issues at hand, not excuses, not reasoning why it's happening. It's not that we don't care, it's that we can't afford to take the time to keep coming back to those considerations. We need solutions now so that we don't need to close down any of our already existing affordable housing units. If we do that, we then just continue to impact the homelessness crisis. We continue to put people back out on the streets, not because we want to, but because we can't afford to keep those units up and running for the people who are the most vulnerable. So I just want to make sure that has been very clearly stated and very clearly heard from all affordable housing providers' perspectives, that they're seeing the impact right now. They are so incredibly worried about this. Some of our agencies are now having to dive into the decision-making process of, do we close down our units? Do we pull from another program budget and close that program down? Do we just not file a claim with our insurance companies and pull from some imaginary budget somewhere else so that we don't see these significant premium increases and that they don't impact them further down the road? Although we are also hearing that several of them never even filed claims for years and years and years, and they're still seeing that increase. So overall, yeah, I don't know what the answer is, but I do know that we have to continue to heavily advocate for solutions for providers whose voices across the state might not be being heard in the proper or appropriate spaces. So those are kind of my closing remarks. If anybody has any questions or wants to add anything else, we'd love to hear it.
Thank you so much, Linda. That was a perfect closing, though it's just the closing of this part of the discussion. The issue remains, it's enormous. And I appreciate Patience and the Housing Development Consortium for bringing us together. This was a really nice variety of folks providing housing throughout the state, different kind of housing. We all have the same mission. And in this respect, for insurance and state support of what we do, we all have the same need. So we will continue to amplify our voices to the legislature. Thank you so much, Senator Kuderer, for being here. Thank you, Representative Peterson. And there was an aide also for Representative Noel Frame, who was on the call. So if there are others I missed, I thank you for being here. And Patience, I look forward to HDC being able to disseminate to your membership the results of this discussion and helping us to move forward.
Thank you, Flo. Great work, exceptional facilitation, and just the depth of discussion that we had. This is a critical moment for the sector, and it's going to take deep, coordinated collaboration. It's an unprecedented challenge, but to see the affordable housing providers, the community action agencies, the lawmakers, representatives from OIC, folks who are helping with brokering, insurance, and underwriting, all of us being here having a solutions-oriented discussion gives us hope that we can get there. So looking forward to following up. We'll be pulling together all of the resource links that we included here, some of the critical questions raised to inform the next steps on how do we get to a point of solving for the challenges. And with that, wishing you a restful weekend. Thanks, everybody.
Thank you.
Thanks all.